Hi, this is David Green, one of the owners at CJM Wealth Advisors. Thank you for joining us for this second video of the estate planning series. We're going to cover some additional topics today and appreciate you joining us. So without further ado, I'm going to turn to the experts here, Dan Vaughn and Martha Sotelo. Some other topics that come up in our conversations with our planning clients, one is gifting. Okay, so Mr. and Mrs. Davis are back with us. We're really excited they're back with us. And they, for their 3 adult children, or their 2 children, both Martha and Dan, they do feel, surprisingly, they want to help both of them out. How do I do it? What are the limitations? What do I need to think about as far as gifting?
So we start with the gifts that can be made where nothing needs to be reported. There's no formality to it. Effectively, they're gift tax free. And there are 2 things to know there. Number 1 is there is an annual exclusion for gift taxes. And that's the amount of money that you can give any one person every year without having to report the gift. And that amount is indexed for inflation. It's currently $14,000. It's indexed in $1,000 increments. So it's $14,000 now. Every person can give any other person.
You could give me.
I could,
Yes.
Dave. I could give you $14,000. And because I'm married, we could give you $28,000. It's getting better for you, right?
It really is.
So $14,000 a year for anything. Okay, and I can give it to you, or I could pay a bill on your behalf, or I could pay down your debt. I can give you $14,000.
So Mr. and Mrs. Davis could give each of their kids, I'm good at math, $28,000.
Correct.
And not have to do gift tax returns. Yep. We're good to go.
That's right. There are 2 exceptions that allow them to gift outside of that, and still they don't have to tell anybody.
So even more.
Even
it gets better.
But wait, there's more.
Yeah.
So if the gift that they're making is for tuition, and it's paid directly to the school, 2 requirements there. Tuition only, paid directly to the school, that's above and beyond the $14,000 per person per year.
No maximum.
No maximums. And it doesn't reduce the $14,000 per person per year. Second exception, a little more broad, is medical payments made directly to the provider. Again, it has to be made directly to the provider. We can't, on either of these exceptions, we cannot trace that the money went from the Davises to the kids to the tuition. It has to be direct or it's not going to work. And so you can pay for medical care to the provider, tuition to the school, and the $14,000 per person per year. That's the limit of the gifts that can be made before we have to start talking to the IRS about our gifts and reporting them.
So interestingly enough, Mrs. Davis's mom is still alive. So grandma could gift to the 2 kids, because we're now going back to the 1720 scenario, and one of the kids chose to go out of state into a private college. How dare she or he? And so wouldn't it be nice for Mr. and Mrs. Davis to get some help?
Mr. and Mrs. Davis would love
So the grandmother in this case could gift to the grandchild.
And could pay the tuition directly with no limit?
No limit.
Plus the $14,000 per person.
If the kids were a little younger, like 13, braces would be a big gift too from
directly
Grandma.
to the provider.
So we may be planting some seeds for the grandparents who are listening in here as to what may happen going forward. So those 3 scenarios, pretty straightforward, very helpful, I think, as far as gifting. What else?
So I think it's important to note, so what if they decided, one child, Martha or Dan bought a new house. There we go. Great. Dan buys a new house and decides he needs a little help with the down payment. And parents are like, well, how do we do that? Let's give Dan a gift of $114,000. And because they're wise parents, they also give Martha a gift of $114,000 too, because we want to keep it equal. What's the impact of that? Well, there is an impact because we have what's called a unified gift and estate tax system. You might have heard of the estate tax exemption amount. Currently, that number for 2017 is $5,490,000. So what the issue is that you have the right to use that during your lifetime to make gifts up to $5,490,000. Or if you don't use it during your lifetime, then at death, your estate has the full available exemption amount. If parents give a gift of $114,000 to Dan and $114,000 to Martha, the good news is that $14,000 is off the radar, right? We just talked about it. But that $100,000 has to be reported, and it has to be reported on a gift tax return that's filed by April 15th, the year following the year of gift. And the impact of that $100,000 is that will reduce that estate tax exemption amount by $100,000. So if you had $5,490,000, and let's say mom gave me $114,000 and dad gave Dan $114,000, then their exemption amount, that estate tax exemption amount, will be less by the amount of the gift at the time of their death.
Really, really helpful. So, because I think many of our clients and individuals maybe don't have the benefit of gifting hundreds of thousands of dollars. So it's good for them to know that if I wanted to give $5,000 to each of my 3 grandkids next year, that it's under that $14,000 annual gift tax exclusion. That's a good takeaway. If we're talking about larger gifts, the takeaway, because we can get into split gifting and how it applies.
Right, I was trying to keep it simple.
No, and I think you did a great job in doing so. What we want our listeners to take away is you really need to sit down with the estate planning attorney and the accountant, and so that everybody's aware of, because there's different scenarios and we won't get it, but you can also make loans, but there's requirements if you're going to make a loan to the son or daughter sort of things. But so really good conversation on the gifting side. And then you mentioned, Martha, the estate tax, and we'll go back to Mr. and Mrs. Davis. They have a $3 million net worth.
Okay.
How do the current estate tax regulations apply to them?
So let's go back to just real quick on the gifting side of things. So let's say they made those $100,000 gifts. You know, the good news there is that probably won't have any impact, because unless that $3 million estate grows to exceed, $5,490,000, it probably is not going to have a tax impact on their estate. Does that make sense? If because a lot of times clients,
so they're okay.
Yeah, they're okay. Yeah, they got to file a Form 709 gift tax return. They got to tell their a CPA that they made the gift, but after that, they're home free. Again, if their estate is $3 million and our estate tax exemption is $5,490,000
each, right?
Well, each. So everybody has $5,490,000, but depending on how they structure their estate plan, will determine whether or not they get 11, or on the second death they just get the $5,490,000. So there are some estate tax strategies that it's important to go talk to an attorney. I don't think we should probably get there today.
Right.
But if you wanted to take advantage of both exemptions, the bottom line takeaway there is that planning is required.
And so if the Davises have $3 million, assuming they do proper planning, the estate tax is not going to apply.
It's a non-issue.
The other takeaway from a planning perspective, especially for our clients, when we sit down with them and do our annual reviews, we always look at the balance sheet and we look at where it was the year before and where it is now. And it's a great document to take into the estate planning attorneys. And in fact, I think you have your own questionnaires that are pretty close too, so that they know not just how much you have as far as assets and how much you owe as far as liabilities, but how it's owned and those sorts of things.
It's critical that we understand how those pieces operate together. Absolutely critical. And I would say as a planning point, if you went to an attorney who did not ask you to see how all the assets are held and what the values are, then you're really not meeting with someone who is giving you the service that you need.
There are a couple of reasons why that granular level of detail matters from a planning perspective. Number one, assets pass through an estate planning system differently based on the type of asset that it represents. Real estate is going to pass through an estate plan differently than a checking account will. A retirement account and the income tax consequences that come along with that's going to pass through the system very differently than life insurance, which is income tax free. So the types of assets matter, and the amount matters, because you could have a scenario where the estate's $3 million now, but based on information, based on what the assets are, based on projected future events, we have to be aware, because the trick when talking about estate taxes, the data points we have are what the assets are now. And it's important to focus on those because that's what we know. But anticipating whether there's an estate tax liability that may arise at the time of the second death means we're going to be talking about what we think the assets will be at the time of the second death. Not that we're going to try to predict that now. We just need to allow for the fact when we assess, do we need to talk about estate taxes? Is this an estate that could have estate tax exposure? Looking at it now is important and forecasting where we think that's going to go.
Right. So recently I had husband and wife, early 30s. Husband had just started working for a company where he was being granted stock options.
Sure.
So on paper, their net worth was in the 3s. But he's telling me that those stock options, when they vest, if the company keeps performing at the pace that it's performing, could be $3 to $4 million. So that totally shifted my perspective on whether or not we needed to do estate tax planning for
potential inheritance is another big issue there that sometimes is unpredictable, but other times is relatively predictable.
And I think it's very important, especially just thinking about younger couples again. A lot of times younger couples are going out and very smartly buying life insurance so that if something happens, they're taking care of their children. They do need to understand that life insurance, while it is not income taxable, it can be subject to estate tax. So when they're figuring out their net worth, they should be adding the value of those policies, the proceeds from those policies, into their net worth calculation, which can shift, again, whether or not you need tax planning or not.
Example would be Mr. and Mrs. Davis with the 3 school-age kids, adding together equity in real estate, cash, investments, and their retirement accounts. Let's say that's $3 million. And we do a little digging and we realize that collectively they have $3 million in life insurance coverage. When they're thinking about their assets and their budgeting and their financial planning, they have a $3 million estate. But what the IRS sees, which includes the life insurance, is a $6 million estate. Depending on the circumstances, that may or may not change the trajectory of the planning, but it might.
Right.
And so making sure that you have a good understanding what the value of your estate is for estate tax purposes is really critical.
Well, I think that's important. As one of the takeaways is hopefully will prompt some listeners to go in and meet with the estate planning attorney. And so, what do I kind of bring? And certainly some of your financial documents, your balance sheet, life insurance information, that sort of thing. So, back to our couple, Mr. and Mrs. Davis. They actually heeded our advice and they went in and met some with very talented estate planning attorneys and set up the wills and powers of attorney, living will, medical power of attorney, even did a trust because it applied. So they have all these pretty documents that they signed and they got copies and they're done, right? They don't, they're good.
Right, the documents are done, the project is not done.
I still have more to do, Dan.
Yeah, you do. What you've accomplished in finalizing the documents is you've put the system in place, the platform is in place, the structure's in place. But we have to connect the assets to that structure. If I have built a trust with all of the provisions that I would want to have in it, feel very good about it, worked very diligently with my attorney and my financial advisor, all as a team to make sure that it's exactly what I want. But my life insurance still bears the old beneficiary designation of my brother. Then when I die, that life insurance policy never goes through the estate planning system. So it's important to take a look at how the assets are connected to the system. And I think the word connect is an important one to focus on, because that doesn't mean you're going to transfer the ownership of every asset you own into a vehicle like a trust. It does mean that we need to take some steps to connect the system, the asset to the system. That might be a beneficiary designation to the trust. I still own the account, it's still in my name, it's still in my social security number, still my same account number, but upon my death it will go directly to the trust without going through the will and through probate.
And having read the very thorough funding letters that you send to your clients after they've done, the takeaway here is the work is not done. So make sure when you've done the documents that you work with the other players on the team, the estate planning attorney, the accountant, the financial advisor, if they're part of it, to make sure registration, beneficiary information, etc. is up to date. So all the work that you just did is actually implemented.
Yeah. And I would just jump in a second, because I think it's important to note that how you fund your trust can be as customized as the trust document itself, and a lot of it can depend on where you are in life in terms of, for instance, you're younger and we're just going to name this trust as a contingent beneficiary after your spouse, or we're in the other scenario where Mr. Davis just died and Mrs. Davis is now a widow and all these assets are in her sole name, and then we push heavier to get those assets connected to the trust because there's a greater likelihood that she's older, that she would pass away, and that we would have probate at her death. So the other issue, again, thinking of Mrs. Davis as an older client, is that if we were concerned about incapacity at that point, basically, maybe Mrs. Davis is starting to get a little confused about how to pay her bills or what bills that she should be paying, or just, little things like that. The trust is not only a asset distribution mechanism. At that point, it can be used to help manage Mrs. Davis's assets.
Some of the initial decisions can be simple, but as we delve into it, there is a lot of customization because you want to get it right.
And there's flexibility too. So I guess the main point I would try to drive home there is that you should be looking at these documents. If you set them up in your 30s, you're probably going to be wanting to look at them and revise them at least, probably every 10 years. I think it's going to be stale by the 10-year mark. So somewhere like in the 7 to 10-year mark, you're going to want to be looking and revising and updating not only the documents, but making sure that how you have connected the assets to the trust still works in what you're hoping to achieve with the trust.
Well, Martha, that's a great segue, and we'll kind of pause for a second and transition. To switch it up a little bit, we're going to run through maybe a lightning round, let's say, of some frequently asked questions. Sure. And the reason why it was a segue, one of the most commonly asked questions is, okay, I did my documents and it's been X number of years. When should I look at it again? So your answer to how often to kind of review the documents would be?
I'd say at least every 3 to 5 years. I mean, ideally, it would be great if you pulled it out every year, but let's be realistic. That's probably not going to happen. So every 3 to 5 years, look at your documents, and then probably, like I said, around the 10-year mark, it's been my experience, because I've now been in practice more than 20 years, that at that 10-year mark is probably when your documents are going to be stale. There's something within your family dynamic, with the assets, with the law, that will have changed in that decade that will drive you to get those documents updated.
Good answer. Next question. How much does it cost? Can you give us an idea of maybe a cost range, or more importantly, how you normally pay an estate planning attorney? Is it by the hour?
In our firm, it's a fixed fee. We stray away from the hourly rate on the planning side as much as we can, because we don't want an ominous hourly clock hovering over the room. We want clients to know how much it costs so they can decide if they want to hire us, and then they can feel free to engage through that. So I recommend that you find an attorney who will work with you on a fixed fee basis, and then you just remove the jack in the box. As to what the fee would be, it's going to depend on the scale and scope of the plan that's going to be built.
Good stuff. Martha, next one's for you. LegalZoom. I don't even need an estate planning attorney. Yes? No?
So, unfortunately, when I see LegalZoom wills, it's because there's been a problem implementing that will. So, I don't really have a favorable impression of LegalZoom wills. One of the things, even if the client got the document right, recently I had a client who came in and who thought, the witnesses were optional. There are certain formalities that the law requires for a will to be valid. Witnesses are not optional. Clients unfortunately, you don't know what you don't know. And that's the real fear, is that you could answer a question within their questionnaire process and cause some real confusion and more problems that will be much more expensive to fix after death than it would be to get a good plan.
Back to you, Dan. How do state laws impact estate planning?
Yeah, good question. So we live in a transient area. The good news is that estate planning documents are portable. If they were executed and they're valid in the state in which you created them, they will be honored in every other state. That said, there are specific state statutory rules that would have undoubtedly been used to construct those tools. And the power of attorney and how it works in Virginia might be different than how it works in California. It's not going to be a question about whether it's valid. It's going to be a question about how efficiently it can be used. And so it's something where if somebody moves, they should have it revisited, have an attorney look at it and make some suggestions. But the good news is the documents remain valid when you move.
Should I share the documents with the potential beneficiaries? And if so, why or why not?
My answer is generally no, again, depending on the age and the health of the client. If someone is at a position in their life where I think that successor person is going to be coming in very soon, then I would say share it. Otherwise, I would say keep it where you can tell them where they can find the documents, but not necessarily share the documents.
Let me modify the question and change the word beneficiaries to guardian, executor, representative. Different question.
Sure. We certainly should let them know the documents have been prepared and at the very least where to go to get them. I think when everybody's local, that might be all you need to do. If my decision makers are all within 20 minutes, I can just say, hey, they're in the basement, they're in the safe, here's how you get in it. If I've got decision makers who are across the country, I might feel more comfortable, especially if they're the next one in line for me on the medical directive, I might feel more comfortable if they go ahead and have a copy of that.
Right.
I do think it's important to keep track of the individuals to whom you've given copies, because if you're updating the documents down the road, you want to be able to know where you need to go back and do some version control management on that. I will say I generally err on the side of allowing people to have a knowledge of where the documents are. There can be some relational turbulence if I've given my brother the document because he's the backup to my wife in my medical directive, and 9 years later I ask him for that document back and tell him he doesn't need the next one because he's not in the next one. That can be a little bit difficult. So that's not to say that it's a mistake to give these people documents. I think what it is to ask yourself, let's make sure we can have version control, and let's just at least stress test on the front end. Do we think there could be some awkwardness if we're trying to get these documents back?
As with all of this, it depends on the specific situation.
Right.
We just had a very productive meeting with our clients who created a trust, the estate planning attorney, who happened to be Dan, and the trustees. Because this is supposed to be a trust that will be around for decades for both kids who are adults and grandkids. The takeaway was the peace of mind for the two individuals creating the trust, that the people involved knew what they wanted to have happen. So it can go both ways for sure. Is estate planning necessary if I'm a young married person with no kids?
You need a power of attorney and you need a medical directive. Maybe beneficiary designations might control with respect to any assets that you have. So a will on that one would be the questionable, but definitely power of attorney, medical directive.
How do I make this process less confusing and daunting?
I think for me, this is not a planning process that we find most of our clients super excited to start. Estate planning is something that's almost always more gratifying to have done than to be in the process of doing. I think, honestly, the best way to make it less daunting is to don't envision the whole entire process. Envision the first step of meeting with an attorney to learn. Because I think what's going to happen is during that meeting, a lot of I think this is going to be more complicated than it might end up being, a lot of that can fall away. And having an education from that initial appointment and understanding that there is a roadmap that's manageable, I might have now just met the person who can help me through this. That is really, I think, going to relieve a lot of that anxiety. So just take the first step. Don't think like you're taking all of the steps all at once.
Doing it the first time is usually the hardest. That's what I find. Once clients come in and they get that first process through, then usually subsequent updates and all are just so much easier. So just allocate the time, get it done, then you're over. Then check it off the list.
Any closing thoughts on estate planning, the goal, the process?
Sure. I think I would say two things. Number one, having a plan in place is always better than not having a plan
Absolutely.
in place. And even if you are sitting down thinking about who you might name as guardians for kids or who you might name as agents in these documents, and you're having a difficult time identifying who that might be, having a plan in place that's workable is always better than not. Because if it's hard for you to determine who you'd feel comfortable doing this for you, how hard is it going to be in that default scenario where the court is now identifying somebody? These documents can all be updated down the road. They can always be changed. I'm not suggesting slap something together that's, just puts a plan in place. Be thoughtful about it, but put the best plan in place you can put together now, knowing you can always update it. I meet with clients who say, I don't know what I'm going to want this to look like 15 years from now. And it's related to that first comment.
Sure.
Your plan today doesn't have to be the same plan 15 years from now. We don't have to know exactly what's going to happen 30 years from now.
We don't.
Look out 5 to 10 years and let's put a good plan in place, and we can adjust as we need to later.
Right. Our practice, not only do we handle the estate planning, but we handle what we call the estate administration as well, or the estate settlement after someone has died. So what I can tell you from experience is that clients who have come in, who have done their planning, and who have pretty much followed the advice. Nobody's perfect.
Right.
Nobody's going to get it perfect. That's fine. Well, maybe a couple, but not many. But pretty much follow the advice. Their family will benefit. It is often the case where when we meet with clients after that, we meet with a successor trustee, the daughter, the wife, the husband, and we're sitting down and we're dealing with the estate issues, that it might just be one appointment and they're done. They're off and running. They can take care of everything else. So it is beneficial. It's a gift that I believe you need to give your family, that you can't calculate the value of that gift of sitting down and getting your estate planning together. And I thoroughly believe that.
It is a gift both to the people who are doing the planning and then the people who have to actually implement the plan on down the road. I truly want to thank you both for taking the time to share your thoughts, your guidance, your expertise. And we want to thank you, our viewers, for tuning into this second video. Some great topics, additional information for you. Hopefully you've found it helpful as you look into getting involved into the estate planning process for yourself.